What's up? Future millionaires, last week I was looking at the institutional fund flow data for December, and I noticed something that made absolutely no sense. While Bitcoin ETFs were hemorrhaging over $1 billion and Ethereum was bleeding out $564 million, there was one asset that institutions couldn't stop buying. $483 million in a single month. 43 consecutive days of inflows with zero outflows, not one single day of selling. And here's the crazy part. While this was happening, retail investors were panic selling. The price was dropping. Social media was filled with people screaming that it was dead, that the rally was over, that institutions didn't care. But the institutions, they just kept buying. Now, I'm going to tell you what that asset is in a second. But first, I need you to understand something. Because what's happening right now in the crypto market is the exact same pattern that's played out in every major wealth transfer in history. And if you don't understand this pattern, you're going to be on the wrong side of it. The pattern is simple. When retail investors are scared and selling, institutions are quietly accumulating. When retail investors are euphoric and buying, institutions are distributing. It's been this way in real estate, in stocks, and gold, and now it's happening in crypto. And the asset I'm talking about? XRP. But before you roll your eyes or click away because you think this is just another XRP hype video, let me be clear. This isn't about predictions. This isn't about moon talk. This is about reading what the smart money is actually doing with their capital while everyone else is distracted by noise. Because right now, there's a massive disconnect between what institutions are doing and what the price is showing. And that disconnect never lasts forever. So let me show you exactly what I'm talking about because the numbers here are absolutely wild. XRP ETFs launched in mid-November 2025. In just 50 days, they pulled in $1.3 billion. That made XRP the second fastest crypto ETF to cross the $1 billion threshold in history. The only thing that moved faster? Bitcoin. Think about that for a second. Faster than Ethereum, faster than Solana, faster than every other altcoin ETF that's been launched. Only Bitcoin beat it. And here's where it gets interesting. In December alone, while the broader crypto market was getting destroyed, XRP ETFs absorbed $483 million in fresh capital. Bitcoin ETFs lost $1.09 billion. Ethereum lost $564 million. But XRP? Institutions were backing up the truck. 43 consecutive trading days of positive inflows, zero outflows. Not one day where institutions said, you know what, let's take some profits here. They just kept buying. Now, if you looked at the price during this time, you'd think XRP was dying. It was trading around $2 down from the July highs of $3.65. Social media was filled with posts about how XRP was finished, how it was just another pump and dump, how retail got rugged again. But while retail investors were panic selling and posting copy on Twitter, institutions were quietly accumulating at prices retail thought were too high. This is the disconnect I'm talking about. Institutions poured nearly $500 million into XRP in 1 month while retail was running for the exits. And if you understand anything about market structure, you know this kind of divergence doesn't last. Either institutions are massively wrong and about to lose hundreds of millions of dollars, or retail is missing something big. And I can tell you right now, institutions don't move this kind of capital on hopium and hype. They move it on structure, on regulatory clarity, and on utility. So the question becomes, what do they see that retail doesn't? And more importantly, what's about to happen when this gap closes? 3. To understand why institutions are moving like this, you need to look at what's happening to XRP's supply. And this is where things get really interesting. At the beginning of 2025, crypto exchanges held approximately 4 billion XRP. By late December, that number dropped to around 1.6 to 1.7 billion tokens. That's a 57% decline in exchange balances in a single year. One of the largest annual reductions in exchange-held XRP on record. Now, where did all that XRP go? It went into ETF custody. It went into institutional wallets. It went into long-term hold positions. And here's why that matters. When XRP sits on an exchange, it's available to be sold at any moment. That's liquid supply. But when institutions pull XRP off exchanges and lock it into ETF structures, that supply is essentially removed from circulation. It's not coming back to market unless those institutions decide to liquidate their positions, which based on their buying behavior, they're not planning to do anytime soon. The ETFs have already locked up 746 million XRP. That's 1.14% of the circulating supply sitting in regulated custody vehicles. And that number is growing every single day these inflows continue. So you've got the supply crunch building in real time. Exchanges are running lower on available XRP. Institutions are absorbing more supply every month. And retail doesn't even realize it is happening because they're too focused on the day-to-day price action. Now here's the part that makes this even more significant. Look at who's entering this market. Franklin Templeton, one of the 25 largest money managers in the world by assets under management. Bitwise, Canary Capital, Grayscale. These aren't crypto-native firms gambling with venture capital. These are traditional finance giants with trillions of dollars in client assets. When Franklin Templeton launches an XRP ETF, they're not doing it for fun. They're doing it because their institutional clients are demanding exposure. Pension funds, family offices, registered investment advisors, these are the people calling up firms like Franklin Templeton and saying, we need a regulated way to get XRP exposure. And once that infrastructure is in place, once the compliance boxes are checked, once the custody solutions are live, the floodgates open. Because now every financial advisor in America can allocate a percentage of their client portfolios to XRP without worrying about setting up crypto exchange accounts, managing private keys, or dealing with regulatory uncertainty. That's what's happening behind the scenes. The rails are being built. The supply is being absorbed. And institutions are positioning themselves before retail figures out what's going on. But the supply crunch is only one piece of this puzzle. There are three major forces converging on XRP right now, and when you understand how they work together, you start to see why institutions are moving the way they are. Force number one is regulatory clarity, and this one's massive. In August 2025, the SEC lawsuit against Ripple officially ended. 4 years of legal warfare, finally over. The court determined that XRP sales to retail investors through exchanges were not securities violations. That was the green light institutions were waiting for. Because here's the thing, big money doesn't move into assets with legal uncertainty. They can't. Their compliance departments won't let them. Their lawyers won't sign off. Their fiduciary duties won't allow it. But the moment that regulatory cloud lifted, everything changed. And it's not just the SEC settlement. The Clarity Act is moving through the Senate right now. This is legislation that would provide a clear framework for how digital assets are regulated, how banks can participate, how custody works, all of it. The House already passed it. When the Senate markup process finishes, institutions will have even more certainty about the rules of the road. That matters, because clarity equals capital. When institutions know they are not going to wake up one day to find out they violated some obscure securities law, they allocate. And we're seeing that happen in real time. Force number two is the ETF infrastructure itself. And this is the institutional on-ramp that didn't exist a year ago. Before November 2025, if a pension fund or a family office wanted XRP exposure, they had to deal with crypto exchanges, set up accounts, manage security, deal with the headache of custody. Most of them just said, no thanks, not worth the operational risk. But now they can call up their broker and buy shares of an XRP ETF, just like they'd buy shares of any stock. The ETF issuer handles the custody. The regulatory structure is clear. The tax reporting is straightforward. All the friction that kept institutional money out, gone. And we know this infrastructure works because we've already seen it with Bitcoin. Bitcoin's price increased 90% after spot Bitcoin ETFs were approved in January 2024. That wasn't retail buying. That was institutional capital flowing through the new rails. XRP ETFs are following the same playbook. And based on the inflow data, institutions are treating this like Bitcoin 2.0. They're accumulating at a pace that suggests they see the same kind of long-term potential. Force number three is real utility. And this is where XRP separates itself from everything else in crypto. Just a few weeks ago, Ripple announced a partnership with DXC Technology. DXC is a Fortune 500 company that provides the core banking platform for over $5 trillion in deposits and 300 million accounts globally. They're integrating Ripple's blockchain solutions directly into their Hogan banking system. Let me translate what that means. Banks running on DXC's platform will have native access to Ripple's payment infrastructure. That's not theoretical adoption. That's not maybe one day banks will use this. That's banks getting the tools to use XRP for cross-border settlement right now. Ripple's CEO, Brad Garlinghouse, has said publicly that he expects XRP to capture 14% of the transaction volume currently handled by the SWIFT system within 5 years. SWIFT moves $150 trillion annually. 14% of that is $21 trillion in transaction volume flowing through XRP. Now, I'm not telling you that's guaranteed to happen, but I am telling you that institutions are betting hundreds of millions of dollars that Ripple can execute on that vision. And when you combine regulatory clarity with ETF infrastructure with actual real-world banking partnerships, you start to see why smart money is positioning now instead of waiting for confirmation. Because by the time retail gets confirmation, by the time everyone agrees that yes, this is real adoption, the price will already reflect that information. Institutions are buying the uncertainty. Retail will buy the certainty at much higher prices. Now here's where it gets frustrating. Because even with all this data, even with institutions pouring in $500 million in a single month, even with exchange balances dropping to 7-year lows, most people are still going to miss this opportunity. And it's not because they don't have access to the information. It's because they can't filter out the noise. Let me show you what I mean. Right now, if you go on crypto Twitter, you'll find people saying XRP is going to $100 by the end of the year. You'll find other people saying it's going to zero and Ripple is a scam. You'll find technical analysts drawing lines on charts predicting a crash to 1. You'll find other technical analysts drawing different lines predicting a rally to 10. Everyone has an opinion. Everyone has a prediction. Everyone thinks they know what's going to happen next. And here's the problem. Most people, when they hear conflicting information like this, they freeze. They don't know who to believe. They don't know which prediction is right. So they do nothing. They sit on the sidelines waiting for clarity. And by the time they get that clarity, institutions have already positioned and the price has already moved. Or worse, they listen to whoever sounds most confident. They follow the person with the most followers. They buy based on someone else's conviction instead of developing their own thesis. And then when the price moves against them, they panic because they never really understood why they were in the position in the first place. This is the noise I'm talking about, and it kills more potential gains than any market crash ever could. Let me give you some examples of the noise you're going to hear over the next few months. XRP is centralized. Ripple controls too much supply. It's not a real cryptocurrency. You'll hear this from Bitcoin maximalists who think anything that isn't Bitcoin is a scam. They'll tell you that XRP's utility doesn't matter because it's not decentralized enough. They'll say institutions are being fooled and the whole thing is going to collapse. Ripple is dumping on retail every month with their escrow unlocks. You'll hear this from people who don't understand how institutional demand works. Yes, Ripple unlocks tokens every month, but if ETF inflows are absorbing more supply than Ripple is releasing, it doesn't matter. The net effect is still a supply crunch. But people will scream about dumps without looking at the actual flow data. RLUSD is going to replace XRP. Why would anyone hold a volatile token when they can use a stablecoin? You'll hear this from people who don't understand that RLUSD and XRP serve different functions in Ripple's ecosystem. RLUSD is for settlement. XRP is for liquidity and bridging. They're complementary, not competitive, but that nuance gets lost in the noise. The chart looks bearish, we're going lower, sell now and buy back cheaper. You'll hear this from traders who are trying to time every swing. Some of them will be right, most of them will be wrong. And even the ones who are right will miss the big move because they'll be too busy trading the noise to hold through the actual trend. Standard Chartered's $8 target is unrealistic. They're just trying to pump their own bags. You'll hear this from cynics who think every analyst with a bullish view has an agenda. Maybe they do, but Standard Chartered is a global bank with institutional clients. Their research isn't published for retail hopium. It's published because their clients are asking whether they should allocate capital. And here's the most damaging noise of all. Who do you think you are to buy XRP when everyone says it's risky? Smart people are saying to stay away. Maybe you should wait until there's more clarity. This is the voice of doubt. And it doesn't come from Twitter. It comes from people around you. Friends, family, co-workers who see you making investment decisions they don't understand. They'll question you. They'll tell you you're being reckless. They'll remind you about the last time crypto crashed and people lost everything. And they're not trying to hurt you. They're genuinely concerned. But their concern is based on fear and lack of understanding. They're not tracking ETF inflows. They're not watching institutional positioning. They're not reading regulatory frameworks. They're just scared of what they don't know. And if you let their fear become your fear, you'll miss the opportunity. Because by the time everyone around you agrees that yes, XRP is safe, and institutions are really buying and the price is going higher, you'll be buying at $5 instead of $2. This is the exact same pattern that plays out in every market cycle. Real estate in 2010, stocks in 2009, Bitcoin in 2020. The opportunity is biggest when uncertainty is highest. But uncertainty makes people uncomfortable, so they wait for certainty. And certainty comes at a premium. Now, I'm not saying you should ignore all criticism. I'm not saying you should blindly buy XRP and ignore the risks. What I'm saying is you need to develop the ability to separate signal from noise. Signal is verifiable data. ETF inflows are signal. Exchange balance data is signal. Regulatory developments are signal. Partnership announcements with actual Fortune 500 companies are signal. Noise is opinions without data. Twitter predictions are noise. YouTube thumbnails screaming about price targets are noise. Random people telling you what's going to happen without showing you how they know are noise. If you can filter out the noise and focus on the signal, you can make informed decisions. If you let the noise overwhelm you, you'll do what most people do. Nothing. Or worse, you'll buy high and sell low because you're reacting to emotions instead of data. And here's the brutal truth. Even if everything I've shown you today plays out exactly as the bull case suggests, even if XRP goes to $8 by the end of 2026, most retail investors will not capture that move because they'll buy at $2.50 after the first rally sell, at $2 during the first pullback buy, back at $3.50 during the next rally, sell at $3 during the next pullback, and repeat that cycle until they've destroyed their position with trading fees and emotional decisions. Meanwhile, institutions who bought at $2 will still be holding at $8 because they weren't trading the noise. They were positioned on a thesis, and they let it play out. That's the difference. And that's why filtering out the noise is more important than any technical analysis or price prediction. Now, before you think this is me telling you that XRP is guaranteed to go to the moon and everyone's going to get rich, let me pump the brakes hard. Because the reality is, most people watching this video will not make money on XRP, even if everything I just said plays out exactly as planned. And the reason has nothing to do with the fundamentals. It has everything to do with psychology. Because here's what's going to happen. Some of you are going to buy XRP at $2.10, or you're going to buy at $2.10. It's going to run to $2.80. You're going to feel like a genius. Then it's going to pull back to $2.40. You're going to think the top is in. You're going to sell to lock in profits. Then 6 months later, it's trading at $5, and you're going to feel like you left money on the table. This is what kills people in bull markets. Not the fundamentals, not the technology, not the partnerships. The emotional roller coaster of watching your position move up and down while everyone around you has an opinion about what you should do. And speaking of opinions, let me give you the cold reality about XRP specifically, because there are legitimate risks here that you need to understand. First, Ripple controls a massive amount of XRP. They have 34 billion tokens sitting in escrow. Every month, they unlock 1 billion XRP. Now, they typically relock 700 million of it, but that still means 300 million new tokens hitting the market every single month. That's ongoing supply pressure that ETF inflows have to absorb just to keep the price stable. If institutions slow down their buying, if ETF inflows drop below $300 million per month for multiple consecutive months, that monthly unlock becomes a real problem. Because now you've got new supply entering circulation with nobody there to absorb it. And that's when prices can get ugly fast. Second, Ripple's own stablecoin, RLUSD, might actually compete with XRP for utility. RLUSD launched in December 2024, and it's already valued at $1.4 billion. Banks can use RLUSD for cross-border payments without the volatility risk of holding XRP. Some analysts are arguing that RLUSD could become the liquidity endpoint for Ripple's payment network, which would reduce the actual need for XRP in those transactions. Now, Ripple obviously disagrees with that assessment. But the point is, there's uncertainty here, and uncertainty means risk. Third, macroeconomic conditions could destroy this entire thesis overnight. If we hit a recession in 2026, if the Federal Reserve pivots back to rate hikes, if risk appetite across all markets collapses, XRP is going down with everything else. It doesn't matter how good the fundamentals are. It doesn't matter how much institutions are accumulating. In a full-blown crypto winter, everything bleeds. And fourth, competition from stablecoins is real. USDC, USDT, these tokens can do cross-border payments at sub-penny costs with zero volatility. Banks might just decide that stablecoins are good enough, and XRP's speed advantage does not justify the price risk. So when you hear people throwing out price predictions like $8, $10, $20, understand that those numbers require near-perfect execution across regulatory, adoption, and macro fronts simultaneously. That's possible, but it's definitely not guaranteed. And even if it happens, even if XRP goes to $8 by the end of 2026, most retail investors will not capture that move because they'll sell too early, buy too late, panic during corrections, or get shaken out by FUD. The institutions buying right now, they're not checking the price every day. They're not reading Twitter threads about market manipulation. They're not panic selling when XRP drops 15% in a week. They're allocating capital based on multi-year theses and letting the position work. That's the difference between institutional money and retail money. And that's why institutions make money while retail stays broke. So let's talk about what the smart money is actually doing right now, because this is where theory meets reality. In December 2025, when crypto markets were getting absolutely destroyed, institutions poured $483 million into XRP ETFs. Bitcoin lost a $1.09 billion in outflows. Ethereum lost $564 million, but XRP, institutions were aggressively buying. That's not random. That's not retail FOMO. That's calculated institutional positioning. And when you look at the specific firms involved, the picture becomes even clearer. Franklin Templeton didn't launch an XRP ETF because they thought it would be fun. They manage trillions in client assets. They have entire teams analyzing risk, regulatory frameworks, market structure. When they launch a product, it's because their institutional clients are demanding it. Pension funds, endowments, family offices, these are sophisticated investors with long time horizons. Canary Capital, Grayscale, Bitwise, 21 Shares, all of them launched XRP products within weeks of each other. That's not coincidence. That's institutional demand creating a competitive race for market share. These firms saw the pipeline of capital waiting to flow into XRP the moment regulated vehicles became available. Now, let's talk about what analysts who actually understand institutional behavior are saying, because this is important. Standard Chartered's global head of digital assets research, Jeffrey Kendrick, put out an 8 price target for XRP by the end of 2026. That's a 315% gain from the 1.90 level where XRP was trading when he made that call. Now, before you screenshot that and post it on Twitter as hopium, understand what that target is based on. It's based on regulatory clarity combining with sustained ETF adoption to drive mainstream institutional recognition. It's based on the assumption that ETF inflows continue at current pace and that Ripple's on-demand liquidity service gains actual traction with banks. Those are big assumptions. But Standard Chartered isn't some random crypto Twitter account. They're a global bank with actual institutional clients. When they publish price targets, it's not for clicks. It's because their clients are asking, should we be allocating capital here? Other analysts are more conservative. Some are targeting $5 to $6 by year end, which would still be a 150% to 200% gain from current levels. That scenario assumes steady ETF inflows around $300 to $350 million per month, moderate adoption of Ripple's payment solutions, and neutral macro conditions. Then you've got the base case, which most analysts seem to be clustering around $2.50 to $3 for most of 2026. That's the stings, everything goes right but nothing goes parabolic scenario. ETF inflows stay positive but don't accelerate. RLUSD gains traction in Asia. Ripple's ODL volume grows 30% to 50% as payment providers adopt on-chain settlement. Macro conditions stay neutral. In that scenario, XRP basically consolidates and builds institutional ownership throughout the year without explosive price action. You end 2026 with a stronger foundation, more institutional positioning. But the price hasn't done anything crazy yet. That's actually the most likely outcome based on historical patterns. Because institutional adoption is a slow grind. It's not a vertical parabolic move. It's steady accumulation over quarters and years, not weeks. But here's what makes this interesting. The downside scenarios are also pretty well defined. If ETF inflows drop below $250 million per month for multiple consecutive months, if macro conditions deteriorate, if crypto winter returns, analysts are looking at $1.50 to $2 as the range where XRP would trade. That's important because it gives you a risk-reward framework. If you're buying at 2.10 with a downside case of 1.50 and an upside case of 5 to 8, that's an asymmetric bet. The potential upside is significantly larger than the potential downside. Now, does that mean you should go all in? Absolutely not. Because remember, most people will not capture that upside even if it happens. But it does mean that institutions are seeing a setup where the risk-reward makes sense for their portfolios. And we can track this in real time. ETF inflows are reported daily. You can see exactly how much capital is flowing in or out. If monthly inflows stay above $300 million, that's confirmation that institutional demand is holding. If they drop significantly below that level, that's your signal that the thesis is breaking down. RLUSD adoption is another trackable metric. If Ripple's stablecoin starts gaining serious traction in Japan and South Korea, where regulatory frameworks are supportive, that validates the utility thesis. If adoption stalls, that's a red flag. The Clarity Act progressed through the Senate is trackable. You can follow the markup process, the amendments, the floor vote timeline. If it passes, that's rocket fuel for institutional allocation. If it stalls, that removes a key catalyst. So smart money isn't just buying and hoping. They're tracking verifiable milestones and adjusting positions based on how those milestones play out. That's the difference. All right, let's cut through all the noise and talk about the price targets that actually matter. Not the Moonboy predictions, not the FUD, just the realistic scenarios based on current market structure and verifiable catalysts. Base case, $2.50 to $3 through most of 2026. This is the steady accumulation scenario. ETF inflows stay positive at $250 to $350 million per month. Not explosive, but consistent. RLUSD gains traction in Asia, particularly Japan and South Korea, where regulatory frameworks support pilot integrations. Ripple's on-demand liquidity volume grows 30% to 50% as payment providers slowly adopt on-chain settlement. Macro conditions stay neutral, inflation stabilizes, rates plateau, nothing crazy happens either direction. In this scenario, XRP consolidates between $2.50 and $3 for most of the year. Institutions keep building positions. The supply crunch continues, but there's no parabolic catalyst that sends price vertical. You end the year with a stronger foundation, more institutional ownership, better infrastructure, but the price action is boring That's actually fine for long-term holders, because boring accumulation at reasonable prices is how institutional positions get built. But it's terrible for retail traders looking for quick gains, and that's why most retail will lose interest and sell before the real move happens. Bull case, $4 to $8 by end of 2026. This is the perfect execution scenario. ETF inflows not only stay strong, they accelerate. Monthly inflows push above $400 to $500 million as more traditional asset managers launch products and existing ETFs gain traction. BlackRock files for an XRP ETF and brings massive institutional credibility. Japan approves domestic XRP ETFs and Asian capital floods in. RLUSD launches in Japan with actual bank corridor volume, not just pilot programs. Real transactions flowing through the system. Ripple's ODL captures measurable market share from SWIFT. The Clarity Act passes the Senate and removes remaining regulatory uncertainty for banks. Macro conditions stay supportive with rate cuts continuing through the year. In this scenario, XRP breaks through $3, consolidates briefly, then pushes toward $4 to $5 by mid-year. If all cylinders keep firing, you could see $6 to $8 by year-end. And that's Standard Chartered's target range, and it requires near-perfect alignment of catalysts. Is it possible? Yes. Is it guaranteed? Absolutely not. This is the scenario where everything goes right and nothing goes wrong. That doesn't happen often in markets. Bear case, $1.50 to $2.0 through 2026. This is the crypto winter return scenario. Macro conditions deteriorate. Federal Reserve pivots back to hawkish policy. Recession hits. Risk appetite across all assets collapses. Bitcoin drops back below $60,000. Ethereum bleeds. And XRP goes down with everything else, regardless of fundamentals. ETF inflows slow to a trickle or even turn negative as institutions reduce risk exposure. RLUSD adoption stalls. Banks stick with traditional systems and stablecoins. The Clarity Act gets delayed or watered down. Ripple's monthly escrow unlocks become a persistent supply overhang that ETFs can't absorb. In this scenario, XRP trades between $1.50 and $2.0 for most of the year. The supply crunch thesis breaks down. Institutional positioning goes nowhere. And everyone who bought at $2 to $3 spends the year underwater wondering when it was going to turn around. This is the scenario nobody wants to talk about, but it's absolutely possible. And if you're not prepared for it psychologically, you'll panic sell at the bottom and lock in losses. Now, here are the specific levels you need to watch, because price action doesn't move in straight lines. It moves through technical levels that matter. 2.28 is the key resistance right now. XRP has tested this level multiple times in recent weeks. A decisive break above 2.28 with strong volume confirms buyer strength and opens the pathway to 250, then 280, then $3. If XRP can't break through $2.28 after multiple attempts, that's a sign that sellers are defending that level and the rally might stall. On the downside, 185 is the critical support. This level is held multiple times. It's where institutions have been willing to step in and buy. A sustained break below 185 invalidates the bullish thesis. It means the supply-demand balance has shifted. It means institutions either stopped buying or started selling. And it opens the door to $1.60, then $1.50s. So if you're positioned in XRP, those are your guardrails. Above $2.28 means the bull case is playing out. Below $1.85 means the bear case is taking over. Between those two levels, you're in no man's land where anything can happen. And here's the most important thing to understand about these price targets. They're not predictions. They're scenarios based on specific conditions. The actual price will be determined by which conditions materialize. If you're buying XRP at $2.10 right now, you're betting that the base case or bull case plays out over the next 12 months. You're betting that institutions keep accumulating, that ETF inflows stay strong, that regulatory clarity improves, and that macro conditions don't completely fall apart. That's a reasonable bet based on current data, but it's still a bet, and you need to size your position accordingly, not based on hopium, not based on FOMO, based on how much capital you can afford to have locked up in a volatile asset that could easily drop 20% to 30% before it goes higher.